What if I told you there's a company that just made a $250 million acquisition, slashed its debt by nearly 90%, and is positioned at the intersection of two of the hottest sectors in the market right now, artificial intelligence and defense spending? And yet, most investors have never even heard of it. This stock is trading under $6 right now, and some analysts believe it could jump 40% or more in the coming months. But here's the thing. There are some serious red flags you need to know about before you even think about touching this one. So stick around, because by the end of this video, you'll know exactly whether this is a hidden gem or a value trap waiting to happen. Before we dive deep, let me be crystal clear. I am not a financial advisor, and nothing in this video is financial advice. I'm just sharing publicly available information and analyst opinions to help you do your own research. Always consult with a licensed professional before making any investment decisions. Now, with that out of the way, let's get into it. The stock I'm talking about is currently trading at $5.82, and it's been on an absolute roller coaster ride. Over the past year, this thing has swung from a low of $2.36 all the way up to over $10, and now it's settled back down in the $5 to $6 range. That kind of volatility tells you right away that this is not for the faint of heart. This is a high-risk, high-reward play, and you need to have the stomach for some serious swings if you're going to be in this trade. So what does this company actually do? They specialize in AI-powered decision intelligence solutions, and their main customers are some pretty impressive names: federal agencies, defense contractors, the intelligence community, and major corporations dealing with supply chain issues and digital identity. Basically, they're building custom AI solutions for some of the most critical and secure operations in the country. And with defense spending ramping up and AI becoming absolutely critical for national security, you'd think this company would be printing money, right? Well, hold that thought, because we need to talk about the financials. Here's where things get interesting and a little concerning. In the third quarter of 2025, revenue actually dropped 20% compared to the same period the previous year, coming in at just $33.1 million. The main culprit? Reduced work on certain U.S. Army contracts. For the full year 2024, total revenue was only $158 million. And here's the kicker, that number has barely moved since 2021. So despite being in two of the hottest sectors in the market, this company has been stuck in neutral when it comes to top-line growth. And it gets worse. The company is still deeply unprofitable. In Q3, they reported a net loss of 3 cents per share and negative adjusted EBITDA of $9.4 million. These are not the kind of numbers that make investors sleep well at night. Where the plot thickens. Just 2 days ago, on January 2nd, this company completed a massive $250 million cash acquisition of a platform called Ask Sage. Actually a pretty big deal. Ask Sage has over 100,000 users and 16,000 government teams using their secure generative AI platform. The acquisition is expected to bring in approximately $25 million in annual recurring revenue starting in 2025. Off the bat, that's a significant boost to the top line. The question is, can they integrate this acquisition successfully and actually turn it into sustainable, profitable growth? Making revenue is one thing, making it profitable is a completely different ballgame. Now here's the company name I've been holding back, BigBear.ai, ticker symbol BBai. And before you rush to your brokerage account, let me tell you what the analysts are actually saying about this stock, because there's a pretty wide range of opinions here. The consensus rating from analysts is a moderate buy, with an average price target of around $6.67 to $7. That represents roughly a 5 to 20% upside from current levels. Cantor Fitzgerald recently raised their target from $5 to $6 while maintaining an overweight rating. But here's the reality check. TipRank's AI system gives this stock a score of 49 out of 100 with a neutral rating. They specifically cited declining revenue as a sign of weakening demand and market share pressures, and those ongoing negative margins show some pretty serious operational inefficiencies. So what's the bull case here? First, the Ask Sage acquisition gives them immediate access to new revenue streams and a massive installed base in the government sector. Second, defense spending is expected to continue increasing, especially with the new administration's focus on military modernization. Third, they've secured some significant contracts, including a $165 million, 5-year deal with the U.S. Army and a $13 million contract with the Department of Defense. And fourth, they just cleaned up their balance sheet in a major way, reducing debt from $142 million down to just $17 million. That's huge for financial flexibility going forward. But let's talk about the bear case, because this is equally important. The core business has been stagnant for years despite being in booming sectors. They're still losing money, and there's no clear path to profitability yet. They're heavily reliant on federal contracts, which can be unpredictable and subject to budget cuts. And that stock volatility we talked about earlier, that's not going away anytime soon. For 2026, analysts are projecting 23% revenue growth to $164 million. But most of that growth is coming from the Ask Sage acquisition, not organic growth from the core business. Here's the bottom line. BigBear.ai is a speculative play on the convergence of AI and defense spending. If they can successfully integrate Ask Sage, stabilize their core business, win bigger contracts, and finally achieve profitability, this stock could absolutely deliver substantial returns. The analyst's price targets suggest anywhere from 10 to 40% upside in the near term. But if execution falters, if those Army contracts continue to decline, or if they can't turn that revenue into actual profits, this could easily drift lower or stay range-bound for a long time. This is not a buy-and-forget investment. This is a stock that requires active monitoring and a high risk tolerance. If you're looking for stable dividend-paying blue chips, this is not your stock. But if you're willing to accept significant volatility for the potential of outsized returns in the AI and defense space, BigBear might be worth putting on your watch list and doing deeper due diligence. If you found this breakdown helpful and you want more deep dives on under-the-radar stocks like this, make sure to hit that subscribe button and turn on notifications so you don't miss the next one. Drop a comment below and let me know, are you bullish or bearish on BigBear.ai? And remember, always do your own research and never invest money you can't afford to lose. I'll see you in the next video.